The table below summarizes these categories. Float. Price range. My favorite strategy: low float. Under $10. Only momentum. Medium float. $10 minus $100. All, mostly VWAP and support or resistance. Large float. Any. All, mostly moving average and reversal. Stocks in play can be found in two ways: pre-market morning watchlist, real-time intraday scans. Let me explain how each day I find my stocks in play for trading. Pre-market gapers. Experienced traders are sensitive to being in the right stocks at the right time. As I mentioned, traders are just as good as the stocks they trade. I and the traders in my community use a scanner every morning that I program to find stocks in play based on the following criteria. Stocks that in the pre-market gapped up or down at least 2%, stocks that have traded at least 50,000 shares in the pre-market, stocks that have an average daily volume of over 500,000 shares, stocks that have average true range of at least 50 cents. There is a fundamental catalyst for the stock. As a rule, I do not trade stocks with an enormous short interest higher than 30%. Why these criteria? When there are some fundamental catalysts, there will be unusual pre-market activity, and a stock in play will have gapped up or down before the market opens with a significant number of shares being traded. I look for highly traded stocks, so that buying and selling 1,000 shares won't be a problem. That is why I am looking at stocks with an average daily volume of over 500,000 shares. I also am looking for stocks that usually move in a good range for trading. That is why I look at average true range. A TER means how large of a range a stock is on average every day. If a TER is $1, then you can expect the stock to move around $1 daily. That is a good number. If you have 1,000 shares, you may profit $1,000 from the trade. But if a TER is only 10 cents, then that trading range is not attractive for me. Let's look at figure 4.2, which is an example of how my watch list will form. On August 19, 2016 at 9 a.m. New York time, my scanner showed these stocks. Figure 4.2- My Gapers watch list on August 19, 2016 at 9 a.m. Eastern Standard Time. As you can see, I have highlighted the gap and float columns on my watch list. From over 4,000 stocks, I now have only 8 candidates. I will go over each of them before the market opens at 9:30 a.m. I will check the news on each of them to learn why they gapped up or down. Is there a fundamental catalyst for that stock? Has there been any news coverage or extreme events for that company? From those 8, I usually select 2 or 3 stocks to watch closely. You cannot watch 8 stocks, and regardless, there are usually no more than 2 or 3 good candidates. I watch the best 2 or 3 candidates closely on my screen, looking for potential setups. I plan my trades before the market opens and then I wait for the market bell. I then trade my plan. I mentioned above that, as a rule, I do not trade stocks with an enormous short interest, nor with a daily volume likely to be less than 500,000 shares intraday. A high short interest indicates traders or investors think a stock's price is likely to fall. But the challenge with high short interest is that these stocks are more prone to a short squeeze by bullish investors and traders. A short squeeze occurs when short sellers panic and are scrambling to return their borrowed shares, forcing prices to increase quickly and dangerously. You do not want to be stuck short in a short squeeze. I am sometimes unable to identify a stock that fits these criteria for being in play on the Gapers scanner. In those cases, I watch my intraday real-time scanner to find stocks in play for momentum or reversal or other types of trades. My first choice though will always be a stock in play that I find on my pre-market Gapers watch list. Real-time intraday scans. For some strategies, you cannot find stocks in the pre-market. The momentum, Top reversal and bottom reversal strategies explained in Chapter 7 are the types of strategies applicable for when a setup suitable for trading happens during trading hours. It is hard to find these stocks during a pre-market scan watchlist. For these strategies, I have specific scanners that look for these stocks, and I will explain these scanners in detail in the next section. Real-time volume radar. During the day, there may be some new stocks in play in the market that I did not catch in my morning watch list. Figure 4.3 below is a screenshot of a scanner on my Trade Ideas software that is set to find real-time stocks for me. That Figure 4.3 my intraday volume radar scanner looking for real-time stocks in play. 1. Have gapped up or down at least $1. 2. Have a TER of more than 50 cents. 3. Have average relative volume of at least 1.5. 4. Have average daily trading volume of at least 500,000 shares. Those are my requirements for a stock to be in play. Having a TER of more than 50 cents is important, because you want the stock to move enough during the day so you can make a profit out of its volatility. There is no point in trading a stock that is moving only 5 cents on average in a day. I will also take a look at the sector of stocks. If I have a few stocks in one sector, there is a good chance that these stocks are not in play. They have high relative volume because their sector is under heavy trading by institutional traders. It is important to know that stocks usually trade with their sector. For example, when oil stocks are selling off, almost all of the oil companies sell off. Therefore, it is important to recognize stocks in play from the herd. Remember, you are only as good as a stock you trade, so if you are the best trader in the world, but in a wrong stock, you will lose money. Real-time bull flag momentum scanner. For the momentum strategy, as I earlier explained, you need to find low float stocks that are moving. You cannot find these stocks unless you are using a good scanner. For a scanner, I use Trade Ideas software. Please check my website for the Trade Ideas link and a discount code exclusive for my trading community. Figure 4.4 my intraday real-time bull flag momentum scanner. In Figure 4.4 above, you can see how I'm scanning real-time for my momentum strategy. During the day, the scanner is finding stocks that have high relative volume, low float, and high activity. I then check them in my trading platform and decide, based on my momentum strategy set out in Chapter 7, if I want to trade them. Real-time reversal scanners. Top and bottom reversal strategies are two other strategies that you cannot find stocks for in the pre-market. You must have an intraday real-time scanner. Figure 4.5 below is an image of a top and bottom reversal scan. Figure 4.5 my intraday real-time reversal scanner. As you can see, I am scanning the market real-time to find stocks that are selling off or surging up so I can trade my reversal strategies. You can read more about these strategies in Chapter 7. I won't go into the details here about how to make these scans, but I will explain in Chapter 7 under each strategy the specifics of what to look for in stocks in each category. If you develop new strategies for yourself, you can also define new scanners for yourself. These scanners are highly adjustable, and you can change the parameters as you like. These are the parameters that work for me, but as you gain experience and learn more about other strategies and your trading style, you may very well decide to define new scanners for yourself. Many new traders don't initially need a scanner. If you join a community of day traders such as mine, you will be able to see my scanner in real time. These scanners are costly, around $100 per month, so at the beginning of your career transition to day trading, you will probably want to keep your expenses down as much as possible. Planning the trade based on scanners. Once I find my stocks in play, I start to look for the individual setups in them. I constantly monitor their charts and try to plan a trade based on the strategies detailed in Chapter 7. I usually select 3 stocks in play and watch them separately on my 3 monitors. When I see a potential strategy, I plan my trade. This is a fast decision-making process. Sometimes you have to plan a trade in a few minutes, and at other times in just a few seconds. This is why you need months of training in simulator accounts to well understand the decision-making process. I focus considerably on quality versus quantity. There are millions of traders out there, and there are no doubt millions of strategies out there as well. I had to find the strategy that worked best for me, my personality and my account size. I've found a strategy that works really well for traders in our community as well as for my own personal trading. This strategy involves taking only the best setups and waiting on the sidelines until I see something worth trading. Day trading can be a boring profession. Most of the time you are just sitting and watching your list. In fact, if day trading is not boring for you, then you are probably overtrading. If you require a reminder of the importance of patience in trading, here it is. There are plenty of traders out there who are making the error of overtrading. Overtrading can mean trading 20, 30, 40, or even 60 times a day. You'll be commissioning your broker to do each and every one of those trades, so you are going to lose both money and commissions. Many brokers charge $4.95 for each trade, so for 40 trades, you will end up paying $200 per day to your broker. That is a lot. If you overtrade, your broker will become richer, and you will become, well, broker. Remember, your goal should be to trade well, not to trade often. Another problem with overtrading is risk. While you're in a trade you are exposed to risk, and that's a place you don't want to be in unless you have proven that there is a setup in the strategy worth trading. Here is my next golden rule. Rule 8. Experienced traders are like guerrilla soldiers. They jump out at just the right time, take their profit, and get out. The stock market is controlled by machines and highly sophisticated algorithms, and, as a result, there is considerable high-frequency trading. High-frequency trading creates significant noise in the price action and is specifically designed to shake out retail traders like you and me. You must be smart. Don't expose yourself to them. Profitable traders usually make only 2 or 3 trades each day. They then cash out and enjoy the rest of their day. Chapter 5: Tools and Platforms. Like starting any other business and profession, to start day trading you require a few important tools. You need a broker and an order execution platform. These are tools you will definitely need for yourself. As I explained in Chapter 4, you will also need a stock scanner to find your watch list and look for potential real-time setups. You may not need a scanner, though, if you are part of a trading community. People who are part of our community can see my screen in real time and use my scanners. What broker to use? For day trading, you need a good direct broker. In fact, you don't just need a good broker. You need an awesome broker. Your broker is your vehicle to trade. If you have a bad broker, you lose money, even if you are trading properly and accurately, because your broker eventually has to fill your order on time and at a good price. There are many brokers out there with various software and price structures. Many of them are great but expensive, some are terrible but cheap, and many of them are either terrible or expensive or both. For the sake of keeping this book short, I will not start reviewing all of them, but I do have additional information on my website about brokers and which ones to choose. Please visit my website and access that information. I will share here though what broker I am using and why. But before that, let me explain the pattern day trade rule. Pattern day trade rule. The U.S. Securities and Exchange Commission and the Financial Industry Regulatory Authority enforce laws that limit the number of trades a trader can make if they are undercapitalized. The rules adopt the term pattern day trader, which includes any person that day trades 4 or more times in 5 business days. Under the rules, a pattern day trader must maintain a minimum equity of $25,000 on any day that they day trade. The required minimum equity must be in their account prior to any day trading activities. If the account falls below the $25,000 requirement, the pattern day trader will not be permitted to day trade again until their account is restored to the $25,000 minimum equity level. Although many new traders who do not have more than $25,000 in their account do not appreciate this rule and see it as a barrier, it actually is in place to protect amateur traders from losing their limited capital to the high fees and commissions of brokers. It has been established to protect traders, and not to work against them. This rule represents a minimum requirement, and some broker-dealers use a slightly broader definition in determining whether a customer qualifies as a pattern day trader. Traders should contact their brokerage firms to determine whether their trading activities will cause them to be designated as pattern day traders. This rule is strictly enforced by brokerages inside the United States due to their regulation by FINRA. However, offshore brokers, who have their main office and activities outside of the United States, are not subject to this rule, and they do not enforce the Pacific Daylight Time rule on their customers. This creates an opportunity for new traders who fall below $25,000 in their account to be able to day trade if they open an account with offshore brokers. Surrey Trader, Capital Markets Elite Group Limited and Alliance Trader are examples of offshore brokers. These brokers offer no Pacific Daylight Time restrictions to undercapitalized traders, and in return they offer a slightly higher commission fee structure. Using these brokers does require some consideration. The US SEC and FINRA strictly monitor and enforce regulations on US brokers to ensure that customers and traders are protected from brokerage firms. Offshore brokers, on the other hand, are not regulated by US authorities. Offshore brokers are regulated by authorities of the country they are operating in, but often these regulations and regulators might not be as strict and diligent as they are in the United States, and there is an inherently higher risk when working with them. I personally use offshore brokers, but I do not feel comfortable to keep large amounts of money in offshore brokerage accounts for the above-mentioned reasons. For example, I feel comfortable to have $5 to $10,000 in offshore brokerage accounts, but I do not keep $50,000 cash in such accounts. If you have over $25,000 available, there is really no need to use offshore brokers, and you can therefore day trade with US-based brokers. I recommend that traders who use offshore brokers withdraw their funds regularly, and if they can ever increase their account size to meet Pacific Daylight Time rules, they should open an account with one of the US-based brokers. Other countries and jurisdictions might enforce similar Pacific Daylight Time rules for their residents. I recommend that new traders contact their local brokers and ask about the minimum requirements for day trading in their jurisdiction. Conventional brokers versus direct access brokers. Conventional online brokers usually direct customer trade orders to market makers and other liquidity providers through pre-negotiated order flow arrangements. This multi-step process often takes time, from a few seconds to several minutes. These brokers often do not offer a super fast execution as their services tend to place a greater emphasis on research and fundamental analysis functions over speed execution. These brokers, at times called full-service brokers, provide research and advice, retirement planning, tax tips, and much more. Of course, this all comes at a price, as commissions at full-service brokerage firms are much higher than those at direct access brokers. Full-service brokers are usually well-suited for investors and retail swing traders, but due to the lack of speed execution, they are not a good choice for day traders. As mentioned several times now, day traders need a fast and flawless order execution as their entry and exits are often only literally 1 or 2 seconds apart. I often get in and out of trades in a matter of a few seconds and people wonder how I can do it so fast. Direct access brokers are the answer to this question. These firms concentrate on speed and order execution, unlike a full-service broker that focuses on research and advice to investors. Direct access brokers often use complicated computer software that allows traders to trade directly with stock exchanges such as the Nasdaq and NYSE, or with other individuals, via electronic communication networks. Direct access trading system transactions are executed in a fraction of a second and their confirmations are instantly displayed on the trader's computer screen. This has opened up a new avenue for retail traders like us. Decades ago, it was almost impossible for a retail trader sitting in their home office to trade at the exchanges. You needed to pick up the phone and talk to a broker and ask for trades, a process that might have taken minutes, if not hours. Today, active traders can receive fast transactions along with other services such as streaming quotes and market data, interactive charts, Level 2 Nasdaq quotes, and other real-time features that previously were accessible only to Wall Street professionals. In the last few years, these brokers have cut down their costs significantly and increased efficiency, which provides traders like us a significantly lower commission than traditional full-service brokers. Although direct access brokers are a must for day trading, there are some disadvantages in using them, including volume requirements and technical knowledge. For example, some firms charge inactivity fees if a minimum monthly trading volume has not been met. Interactive Brokers charges a $10 per month inactivity fee on low net value accounts generating less than $10 a month in commissions. Many firms will deduct transaction fees and commissions paid each month from that month's inactivity fee. Hence, an inactivity fee often serves as the minimum monthly commission which is paid to the brokerage. However, not all direct access brokerages have minimum monthly trading volume requirements. Another challenge is that new and inexperienced traders may find it difficult to become familiar with direct access trading. Knowledge is required when dealing with processes and procedures such as making trade decisions and order routing. That is why I always recommend traders practice on their broker's simulator platform and ensure they are very familiar with the platform before they open a real account with that broker. In direct access trading, you are only one click away from making a dangerous mistake and blowing up your account, while if you are on the phone with an agent in a full-service brokerage, the agent may catch your mistake or advise you before executing your order. Please note that recently many brokerage firms have begun to offer both direct access and full-service services, so it is best to check their website and inquire about their services. For example, in Canada, BMO Bank of Montreal Investorline, RBC Direct Investing and SIPC Investors Edge are examples of full-service brokers that are generally not suited for day trading. On the other hand, Interactive Brokers Canada and Questrade offer both direct access trading and full-service brokerage services.